invest in real estate. I am Tiffany Joseph, the broker of Joseph Realty Group. I also want to welcome my host, Chelsea Collins. And tonight we have a very special guest. We have the CEO of Rapid Funding Solutions, Mr. Milton Jeffries, and he is going to talk to us tonight about alternative financing options that really investors and business owners can look at pursuing to really get into real estate. So, Milton, thank you for joining us.
Yes, I'm glad to be here. Thanks so much for having me. I'm excited to talk to the audience tonight about real estate and what we have to offer as well.
Awesome. So, can you tell us a little bit about Rapid Funding Solutions?
Yes, we are essentially a brokerage firm, and we exist to help business owners and real estate entrepreneurs gain access to capital. There's a lot of options out there when it comes to finding money for their real estate deals or their business transactions, and a lot of folks just don't know where to go. They don't know what the process is going to look like, and how does it start, how does it finish, and that's why we exist. We like to help entrepreneurs and real estate investors get the access to the money. We hold their hands, get them through the process. We show them all the ins and outs to make sure that we ensure their success and achieve their financial goals.
So that's exactly why I asked you to join us tonight, because I think it's important. And I think for a lot of our viewers, they're actually first-time investors that are wanting to purchase their first real estate property. And instead of purchasing their first property to be their primary residence, they want to purchase something as an investment, whether they may live in one part of the home or the unit and rent out the other, or just have it completely be something that they rent. So most people know traditional financing. So when people know of, hey, I'm going to purchase real estate, they know of, I'm either going to get an FHA loan or a conventional loan. So can you explain some of the differences between the funding solutions that you offer versus those traditional options?
Absolutely. I always get excited about talking about rental properties and financing. When you think about alternative financing, essentially what we are is non-bank financing, right? Which means you step out of the world of the FHA financing, which can be like hold off loan, which essentially means you're going to have to provide tax returns and W-2s and all of these things in order to get the type of bank style financing. Alternative financing is a lot different. It's all about the deal. The credit score requirements are lower. The overall documentation needed to get through underwriting is far easier, and the process is, oh gosh, so many times faster than it would if you were going through the regular conventional style of financing. There's a major difference when you're talking about being a real estate investor. You have a lot more flexibility when it comes to alternative financing to still achieve your deals and get them done.
Yes, so that's awesome. So can you explain, I know you hit on rentals as one way to, purchase property. So when you're talking about a rental, that's someone who would buy the property and they're going to hold it. Is that the correct term that you would use for that?
Yes.
Okay. So can you go through some of the other ways that people who would also come to you for financing outside of buying and holding?
Absolutely. We have the rentals first. We have a lot of clients right now that are doing the fix and flips right now, where you buy it, you purchase the property, you update it, renovate it. And sometimes that's just some simple cosmetics, new windows, new paint, or it can be, gutting it down to the studs and starting it over. So we have the fix and flip, as they call it in this market, or as a purchase and renovate the property so that you can then turn around and sell it, typically for a decent profit. We also have a process called the buy, renovate, refinance, and then rent. So they purchase it to renovate it first and then convert it to the rental. And then we also have the new construction side of things, where you can build a property. If you've got some land, we have a lot of folks that inherit land from family members, or family that's just been sitting on land for a while and they want to do something with it. Now is really a perfect time for new construction, even for first-time investors. Depending on the location, the geography of where it's at. Rates right now are great for that type of thing. And I tell you what, just this week alone, there's been a lot of new construction programs that have come back into the markets, which is great. And, but prior to the COVID environment, things were a lot different. And then we dealt with COVID and a lot of things changed in lending, but it's starting to really balance back out. And one of the benefits of that is the new construction that's now available to first timers, if you can imagine that. And it's primarily because so much of the market is moving right now when it comes to real estate. If you can build something new, that's what folks want. And the markets recognize that. The lenders recognize that as well.
Well, that's awesome. I think a lot of people, with the prices of real estate, just building something from scratch is, also a dream, right? To be able to just purchase the land and do that. So can you talk a little bit about how someone would go about that process? So let's say it's someone who, maybe they've been working for a few years and, they have stable income. They have, a good credit score, and they're like, hey, I want to get into real estate, and I want to be able to purchase land and then build a duplex, as an example.
Right. So, that's actually a great question. The first key to that you mentioned is having great credit, which is good. That gives us the avenues to start within some really good rates in terms. Right now, when it comes to new construction, the way that it's viewed is that when it comes to the financing, we look at a loan to value, a loan to cost, and then an after repaired value. And essentially what that means is in the overall deal, let's say that the whole project, if we're using round numbers, is, $100,000 deal to buy the land and build a home. Well, we look at what is the after repaired value of that going to be. Let's say it's 250,000 and we're looking at 75% of the after repaired value. What that basically means is we would take 250,000 multiplied by 75%. And that's where we would construct the entire or structure the financing around those figures for the purchase of it, for the cost of the actual construction. In those types of deals right now for new construction, we do 85% on the loan to cost, which is pretty much the industry standard. And what that means is you just got to have 15% down. Now, here's the thing about it. Because of COVID right now, we're able to do new construction financing up to sometimes 96% of the cost of it, which is amazing. And in other scenarios, even as high as 100% on the new construction, which is absolutely amazing, up to 70% of the after repaired value. So using round numbers, if the after repaired is 100,000, we can finance everything up to 70,000. Now, that's a small example. But it tells you that if you're making the purchase of the land for 25,000 and then the rest of your construction costs and everything is 50,000, then we're going to cover all of those costs. Now, we put that out there just as an example, just so you kind of see how the numbers work a little bit. But the new construction right now is a great program. The process, again, if you've got a good score, you'll need a little bit of cash reserves, as we call it, or the money to put down. And oftentimes when you're doing the new construction, the way that it is expected from the lenders is that when you go out and you start the construction, let's say you're going to build the foundation first, and let's say it costs $7,000 to do that foundation. Well, the reason you'd have to have some cash in reserves is because you've got to actually start the construction yourself. It's done on what's called a construction reimbursement. So as you do the construction, the lender reimburses you for the money. All of the money up front is set into an escrow account, so you can see it. It's there. It's waiting for you to come and get it, essentially. So once you start the process, you've got to have a little cash, get it started, and then as you move through the deal, you're actually paid back and reimbursed until the entire property is built. We have options when it comes to new construction to, again, depending just on the credit scenario and a couple other variables, where there can actually be no payment during the construction period. In other loans, it's actually escrowed into an account for, let's say, 8 months of interest reserves. And so the lender will actually fund against the construction and just carry that over into the escrow so that you can build a property, spend your money on building it, get it up, and then get it sold. And we see quite often that homes that are being built now, are just selling inside of the 6 to 8 month cycle. And a lot of them are actually pre-sold. We have a developer here in town who actually did a little bit of marketing and pre-sold 15 homes before he even broke ground. So the new construction markets are great right now. You just want to make sure that you've got a little cash set aside for your reserves, can cover, the 15% down payment, and then kickstart your reserves so that you can get going.
That's awesome. That is awesome. So, what about if someone unfortunately doesn't have that 15 to 20% down? Are there any other options or avenues that they could still pursue in getting some type of financing?
Yes, in this market, there are some very creative, flexible options out there right now. There's this thing called credit card stacking, right?
Mhm.
And all it basically means is that you can get access to anywhere from 50 to $250,000 at 0% for 12 to 18 months. Now, it does require that you have good credit, and typically they look for 680 plus scores, and they want to make sure you've got a couple other credit lines already, so you're not new to credit. But I tell all of our business owners and entrepreneurs that using those types of lines is a business strategy. It's strictly a business move. I'm using this cash because I'm going to use it to leverage my way into a real estate acquisition that's going to be either a lifelong hold, or I'm going to build it and sell it for a nice amount of profits. The average real estate deals that we see these days, there's anywhere from 40,000, 50,000 in profits that folks are making on each flip, which is amazing.
Yeah, I really love that idea when we talked about it before the call, because it allows people who maybe, I think a lot of times people get nervous about getting into real estate because they're like, oh, I need 20% down, or think that they need a large a large lump sum of money. But that example that you shared about the credit card stacking really allows them to be able to set up their real estate investing business and be mindful. It's not that you're wasting it on frivolous things. You're saying, hey, I'm going to do this credit card stacking for a purpose so that it can generate income for me. And then it's kind of, getting your foot in the door in a different way.
Yes, that's right.
Yeah, yeah, exactly. So what would be some type of, so with traditional financing, there's always like a long list of things that people have to show to even be considered for financing, from tax returns, pay stubs, your mom's this, your dad's that. There's always just like a long list of things. So just briefly, if someone wanted to come to you for financing, what would kind of just be like a general thing that they would need to show upfront?
So here's a really interesting thing about it. Alternative financing is called low doc or light doc, sometimes no docs at all, right? The thing is, the limitations on the documents are actually great. You just mentioned several key things there. Tax returns, if you're a W-2 employee, showing the W-2s, the paycheck stubs, the bank statements, all of those things. When you step into the alternative finance world, all of that kind of goes away. The requirements to get a loan are very simple. You got to have an LLC. You got to have a business, right? You can go online, you can set one up very quickly, but you got to have the LLC. We're going to ask for the documents for that LLC. We're going to ask for a driver's license, and then we'll just ask for whatever cash flow statement you have that shows the cash reserves or the money to put down. That's it. Um, yeah, and it can be a bank statement. It can be your retirement account. It's whatever you've got that's liquid. And if you've opened you've got the LLC open, you've opened the business account, and you've got the money there. That's what we look to see in order to get you qualified. It's really that simple, to be honest with you. That, and then the purchase contract for the property you're going to buy and flip, or the land contract for the deal you're going to buy to build something.
Yeah. So question, would they need to put, so let's say they do have a W-2 or they're receiving income, but they start the LLC. Do they have to put the money in from, let's say, their personal account into the LLC so that you could see it's associated with that company?
No, they do not.
Okay.
Actually,
Okay.
yeah, very
So that's,
interesting thing. Yeah, about the alternative finance world. The proof is in the cash. As long as you have the money that you say you have, and you can show the bank statements, and you're going to use it for your deal, essentially. So yeah, no, it doesn't have to be in the business account. It can be in the personal.
and also wanted to ask you about timing. So again, I'm comparing back to traditional because that's what most people know, right? With traditional financing, it could take 30 to 45 days once you put in a contract, because there's so many steps that goes through. But with you going through your different solutions, how long, if someone came and, showed the money, had the reserves, came to you with a contract, typically what's the average length of time it takes to go to closing?
15 to 21 days.
Yeah, so that's nice. So when they're coming across these, good deals, they can actually jump on it versus having to go through these routes of traditional financing.
Yeah, and that's part of the urgency. Those types of deals, they go quick, right? So when folks come to us, they're saying, "Hey, I'm looking at this deal. 10 other people are looking at this deal. I gotta get qualified today. I need to show terms by this afternoon, and I've got to go make this offer on this deal in order for it to get accepted." And when they do that, those sellers want to know that they're ready to go, that they've got the financing in place and can move very quickly. And because of the low doc, light doc scenario, we can move very quickly when it comes to doing any type of real estate investment type of transaction.
That's awesome. So I want to back up where you were talking about where people will purchase a property to hold, to rent it out, and then they will refinance. Can you elaborate a little bit on that?
Absolutely, and there's actually two avenues with that. We have a lot of investors that they want to increase or even go out and buy their first rental. But they're looking for a deal, right? The whole name of the game is equity. If you're going to keep it and hold it, and you want to buy something that you may purchase it at 125,000, but like if you go ahead and put in another 20 grand to maybe update it, make it nicer, get the granite countertops in, or whatever it may be, that the value can increase to, let's say, 185 or 205,000, and now you've got that equity sitting in the property, and that's where the real wealth comes in. And so we have a lot of investors that they want to buy it. They want to go ahead and get the cash to make the updates so that they don't have to come out of pocket for that cash as well, right? So we can help them get the type of loan that secures the property, sets them up also with the cash to do the renovations. And we work all this out in underwriting for the timing of everything, but then we can actually help in what we call a single close loan, convert it to the long-term hold. Or we can then turn around in the second option and help them refinance that property. So they're able to purchase it, they're able to update it so that now they have exposure to the upside, the increased value that they now own equity in. And then they can put a tenant into it and let it start cash flowing. It's like a double win on that. You get the tenant, you get the cash flow, but now you also got all kinds of equity sitting in that property as well from the updates that you made to it. So you get the upside two ways.
So that's when they can refinance, is after they've updated it because it's going to show that equity.
And that's exactly right. So a lot of investors, what they do is they'll purchase it, at the whole 65% of the after repaired value. They keep all their numbers kind of within that range. So the day they get done with everything, rehabbing and all that stuff, they know if they're either going to refinance it or sell it, they can take it up to the 75% and perhaps even get 10% right back out, on the front side of it, and then let it appreciate over time.
That's awesome. That's awesome. I just love how there's so many different ways that people are not aware of that they can just start investing, and it's not hard, it's just getting that knowledge, and you've been so informative in sharing, that way. Are there any other ways, just kind of based on our discussion, that you think might be beneficial for our first time investors that are looking to get into real estate?
I think between the buy and holds, between the rentals, new constructions, I think that for the most part that covers it. We also get a lot of investors that look at the multifamily
Mhm.
arena. And if you're not going to do just a single family deal, and I love duplexes, right? Because of some of my first deals were duplexes where you can actually buy it as an investment, obviously, and now you can put two rentals in it, at the same time without having to take yourself into a fourplex situation where it's a little bit more complex, a little bit more investment to do that. It's still simple enough, but it's just above the single family. So I think duplexes are great. Still, when it comes to whether they're going to buy them, fix them, and flip them, or purchase and hold them as well. So you get more into the multifamily side rather than just the single family side as well.
So thank you for bringing that up, because I know with traditional financing, even from a conventional standpoint, once you hit a duplex, right, on a conventional loan, they require you automatically to put 20% down. Like, there's a lot of different requirements. With financing, alternative financing, are the requirements any different for a duplex than they would be for a single family home?
On the real estate investor side, it's still anywhere from 75 to 80%. If you're just going to purchase and rent and hold, it's still around 75 to 80% on the loan to value. If you're going to purchase it and renovate it, then we still bring it back up to the 85% on the loan to
Okay.
purchase. And still we'll do up to 100% of the rehab budget based on the after repaired value, which is typically seven. In today's market, it's anywhere between 70 and 75% now, actually, which it has actually gone up. When COVID first started and all that, all of the loan to value slid down to about 60, 65% to where real estate investors were having to bring more money to the table. In the last few weeks, I mean, their interest rates on investment deals have actually dropped to just yesterday, I think it was, they dropped by a whole point, a whole 1% they came down. And then the loan to values and the loan to costs have gone up to where lenders are trying to get back. They're actually trying to get back to 90% on the loan to purchase is where they're headed right now. And we've gone from 65 to 70 to 75 to 80, and now we're at 85% in the past 3 weeks. So the markets right now are very favorable for real estate investors.
Yeah, I mean, because even when people are thinking about just traditional financing and purchasing their own primary residence, rates are low, but rates are even low, like you said, for investors. So it shouldn't be, no, you shouldn't be scared to go out and start investing now, because this is the time where across the board the rates are lower.
That's right. That's exactly right.
Yeah, that's awesome. That's awesome. So I'm trying to think if there's any other questions. We've covered so much. I'm just
Touch
gonna
on the rates for a little bit.
say that again.
Do you mind if I talk about rates for just a moment?
Oh, that would be awesome. Yes.
Yeah, so here's the interesting thing. Mortgage rates for a primary residence is somewhere around, I think, 2.5% right now, which is like crazy low.
Yes.
In this world, for a 30-year mortgage to be 2.5%. I mean, if I could buy a primary residence over and over again, I would. When you get into the real estate investor side, that's alternative finance, the rates right now are starting at around 5.7, 5.9%, which just even a few months ago they were back at 8.5% because of the COVID markets, right? The fact that they've continued to slide down is a very good sign. But when you think about buying an investment property, and we all have our spreadsheets that does all the calculations and stuff, the biggest thing you want to look at is what is your rate going to be, so you understand what your principal and interest and taxes, insurance, all of that stuff is going to be, and that your property cash flows. But rates right now are literally starting at around 5.75. I've seen some 5.5s on larger portfolio deals. The real estate investors that are saying, hey, look, I got to buy 4 properties at one time type of thing. Those are a little bit better on the rates, but to be able to buy a rental property on a 30-year note right now, in the low 6s, high 5s is absolutely a wonderful thing. And it's good to hold. When you get into the terms for rentals, here's something to know. You have options by way of the terms. So when you buy a rental property, you're going to hold it, and you may have a strategy. You may be thinking, I'm just going to hold this for 5 years because of the location where it's at. It's going to appreciate steady. You want to pull your money out down the road. You may say, I only want it 3 years. You may say, I want it just 10 years. Or you may be thinking, this deal's in such a great location, I'll keep this the full 30 years, right? And you're thinking, I may pass this down to my kids even, right? So when you look at the rate and the term, you will have the option when buying to determine whether you want to go with something like a 5/1 ARM, which is fixed for 5 years and then floats every year after that. You can look at whether you want to do a 7-year note, a 10-year note, or even just a full 30-year note to hold that property. When you get it right now, the way it's set, when you look at per se, a 5/1 ARM, the rate start in, the low 6s. When you go further out, I've seen 30-year notes right now start at around, 6.5 and up, even for, the 680, 700 scores and up. And so just something to think about. The rental hold acquisition type of loans, they do carry a prepaid penalty, right? The prepaid penalty, what it essentially means that once you take this note, you've got to hold it for the duration of the prepayment, so to speak. There's what's called a step down. And so when you buy the property, you're going to hold it. You want to allow yourself to benefit from the cash flow and the appreciation as it increases over time. And so the lender, to mitigate their risk and loan out the money for what they know will be a set amount of time, they'll put what's called a prepayment penalty on there for like 3 years or 5 years, and it's called a step down. So in the first year, it's 3%, and the second year, it's 2%, and the next year, it's 1%, and then it zeroes out so that you can refinance or exit out of that loan anytime. These things exist because with those in place, you actually get a better and cheaper rate on the front side when you make your first acquisition. So these are things that you will absolutely encounter when you think about purchasing and buying to actually hold it for any length of time. Again, whether it's the 3 years or 30 years. We have properties here that, we were able to acquire in areas that are just bar none, great to live in. We know families will be there forever. The properties are appreciating anywhere from 5 to 15% in those neighborhoods. So when you get a deal like that, hey, I want to keep this. It's going to continue to appreciate and make nice income. And then there's other properties which may be a little riskier area just by way of the appreciation, not necessarily bad areas, but may not appreciate as high. And you say, look, I'll probably keep this 3 years, and then I'll take that appreciation, sell it, and flip into something nicer, something bigger, and just keep buying, holding, and then selling and reinvesting the equity into the next bigger, the next bigger, the next bigger thing.
So that is great. I do have a couple questions that have come through from the live. So the first one is, what about people who that don't have good credit? So what are kind of the credit score averages that are considered when coming to you for alternative financing?
So we have, gosh, so many programs available. We have a really strong one that even starts at 620 scores and up. To where we can still get them 85% on acquisitions with the rehab dollars, the whole nine. We can also help them if they're not the 30-year notes. What we do in those situations is we can get them into what's called a bridge, which is just a 3-year note or a 5-year note. So they can still make their acquisition. They suffer a little bit because the rate's a little bit higher than, the 6%. They may be, 7.25 or something like that. Moving forward. And then when you get into folks that have just had new credit or credit challenges, we have what's called just pure asset-based lenders that are not dependent upon credit. When they look at credit, it's just making sure there's no fraud or nothing like that in the background, just simple basic identity check stuff. But outside of that, when we get into the asset-based lenders, they look at the asset, they look at the real estate deal itself and see what's it worth, what's it going to appraise at, how much are they purchasing? They look at the equity and things like that. So you can still get a deal done, even with challenged credit. The keys are getting the LLC up. Make sure that you've got, a little bit of cash to put down, even, in the situation where you might have the lower credit scores. They'll definitely make sure you can bring a little money to the table to, handle your down payments. And if you're going to be doing the rehab, that you can kickstart the rehab, or if you're going to hold it, they'll just want to make sure you have the down payment and can satisfy that requirement.
So this question, I think, came up when you were going through the different types of loans. So the question is, what are the benefits of ARMs?
So the benefit right now is just simply cheaper rates. The shorter ARMs, adjustable rate mortgages, like I mentioned before, the 5/1 ARM, that one carried like I think it was a 6. I'm just thinking of one of the deals I saw go out the door the other day. It carried like a 6.5% rate, and whereas the 10-year and then the 30-year kind of went up to 6.7, 6.88. So the adjustable rate mortgages are primarily for the lower rates, and it has to do with investment strategy though too. How long do I plan to hold this property? We've got some now we know we just want to hold for a few years and then level up or sell them for the equity that we're going to gain in them.
Cool. Well, Milton, we are approaching our time, and I know it's evening and we all want to get to have dinner if we haven't had it yet. But I do want to thank you for joining us and providing just such a wealth of knowledge. I think that for many people, they don't know about these other ways that they can get into real estate investing. So I'm truly happy that you were able to come on and share your knowledge and everything about Rapid Funding Solutions. So if viewers would like to contact you for more information, how can they reach you?
All right. So if they've got questions, they can shoot us an email at the info@rapidfundingsolutions.com. For starters, they can visit our website right now, which is rapidfundingsolutions.com as well. And they can also just give us a call at the office. And we have a local number here in Kansas City. It's 913-214-6377.
And so I do want to point out that even though your company is based in Kansas City, that you are able to assist investors across all the 50 states. Is that correct?
Absolutely. We're doing deals right now in just about every single state.
That's awesome. So everyone, thank you again for joining us for another Facebook Live on when, where, and how to invest in real estate. If you would also like to visit our website at investing.josephrealtygroupfl.com for more information on investing, feel free to check us out, and also follow us on Facebook at Joseph Realty Group and on Instagram at realtor_JRG. So stay tuned for our next series. We're going to continue to have more series about educating the community on different ways to get into real estate investing. So stay tuned for our next episode. Thank you and have a good night.